Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Sorry I didn't post a video in the past week or two. We've been busy with the holidays, resting up, reviewing 2022, looking at 2023. I hope your holidays have also been restful, and if you're watching this video, Happy New Year to you. Wishing you all the great success, wishing you all the best for 2023, wishing you all the great health, wealth, love, happiness, all of that for 2023. Now, let's talk about 2023, what to expect in terms of the markets, in terms of the economy, in terms of the stock market. We'll do basically an overview of what we could see in 2023 for the stock market, bond market, forex, crypto markets, commodities, and so on. So I'll kind of give my take on it, and then you can leave your comments in the comment section below, and let me know what you guys think for what we could see in 2023. Now, let's start with the stock market. The stock market, as we know and as we've been watching since 2022, the start of January to the end of 2022, all the equity indices, if you've been invested in stocks and bonds, you're basically down for the year. Both stocks and bonds ended negative and ended up doing poorly for 2022. Now, if you look at some indices like Dow Jones is not quite far from its all-time highs. In the past quarter or two, Dow Jones has picked up quite a bit. So a lot of the stocks in the Dow Jones index is basically stronger when you compare to S&P 500 and NASDAQ. Now, the lagging index that has really underperformed has been the tech sector, which is NASDAQ itself. And NASDAQ continues to be under pressure, continues to have most of the risk-off sentiment and most of the selling happening there, especially when you see stocks like Tesla, Facebook, Google, and all of these big names. Amazon also basically sell off, and we see Amazon near its COVID's low. We also see Apple basically in December print made a new 52-week low as well. So a lot of these tech names are under pressure. Now, what does this mean for 2023 in terms of equities, the stock market, in terms of the technology stocks, these individual stocks? What could we see going forward? Well, let's start with the economics first. Let's start with the global macroeconomics. Let's start with first, actually, the US, right? What could we see in the US when it comes to the stock market, when it comes to their economy, and most importantly, what are investors and traders looking forward for? What will they be keeping an eye on? And how I see 2023 starting off is the main theme continues to be inflation, continues to be interest rates. Where are we headed with inflation? Where are we headed with interest rates? Are we going to see a pick back up in inflation? Is this the end? Did we peak like we saw the highest print last year, about 9.1%? Are we done, or are we going to reach back, approach those levels because of some geopolitical risk? We don't know, right? So that's the key theme, is the inflation. That's number one. Number two, the other key theme is interest rates. Okay, well, interest rate decisions will be based on whatever comes out from the inflation front. So inflation is expected to be worse off, then sure, you're going to see you're going to see Powell, you're going to see the Fed come out and say, hey, we're going to hike rates more aggressively because inflation's not coming off, right? We heard from European Central Bank, the ECB, say that we need to bring rates to the inflation level, and we expect inflation level next year is going to be around 4%. So we need to bring rates to that level, which basically meets that Taylor rule, which Bullard was talking about, that you need to move, in order to bring inflation down, you need to bring rates at or above the inflation level to really bring inflation lower. So the ECB mentioned that. Now, will they see 4% inflation next year? Yes, maybe, maybe not. I don't know. But that was pretty hawkish for the ECB to come out and say that we're going to hike rates more than expected. And you could see the euro and euro rallied, the bonds sold off, and so on. And it gave basically this very hawkish tone for the euro, which gave it legs to continue to move up higher. Now let's go back, transition back to the U.S. markets, right? Let's talk about U.S. now. Talk about Jerome Powell. According to their projections and their last FOMC meeting, they mentioned that they're going to push rates to around 5.1%. So 5.1% is the area where they expect to move rates. Can that number change 100%? Can it go higher 100%? Can it go lower 100%? So that's the second theme that people are going to look forward to, is that where is this rate ending? Right, we know that we're going to slow down in terms of the jump in the interest rates. Like, we're going to slow down in terms of not hiking rates as aggressively that we've done in 2022, because that's what the Fed said, that we're going to slow down the pace. Unless data tells us that we shouldn't, then of course throw that out the window. We're gonna hike aggressively like we did in 2022. But inflation continues to come down, and there's factors that are showing that. And sure, you're going to still hike rates, but you're going to do it at a more slower pace. So you're talking about 25 basis points. But he didn't mention that the rate hikes are not done. And he mentioned what we should be focused on is what level we should stop. And we don't know what that level is. It could be he put out 5.1% for now. It could be higher than 5.1%. It could be 6, 7%. There are some people and fund managers out there projecting that we could see interest rates of between 7 to 8% this year. That is a possibility. And I don't think that is too far-fetched, especially with the risks that you have. If oil starts to pick up again, if you got this geopolitical risks, right? China reopening, etc., which I'm going to talk about also. But these are some of the risks out there to keep an eye on, that if this happens, will we see the inflation levels not deteriorate as the Fed is expecting? Remember, the mandate is the 2% target. They need to hit the 2% target. They need to get the inflation rate to the 2% target in order to be successful at their job. It's required by the law that the Federal Reserve needs to make sure that the employment levels, the unemployment rate is at a healthy area, and that inflation and price stability is also in a healthy area as well. So, two things. I started off with inflation is the first theme heading to 2023. Where is that going? Number two, interest rates. Are we going to continue at this pace? Are we going to pause? Right? The bond market is saying that there's a potential of a pause coming very soon, and very unlikely that the Fed is going to continue to raise rates as aggressively. So will we see that? History suggests that a pause, that when the bond market starts to predict that a pause is coming, and when the pause comes, it tends to be 6 to 7 months when you get that pause in that rate hike, right? So if we say 6 to 7 months, if let's say we start the pause in January, then we should see the pause basically go from January all the way to June, July, and then basically from there start cutting rates. If we follow what history has taught us, right? So inflation, interest rates. The third thing that is very, very important is growth in demand. This is another key theme for the markets and the economy globally, everywhere. Where is demand going to be heading forward? Are we going to see that earnings, that EPS crunch, right, completely collapse? Are we going to see the earnings, the next earnings season or after that, completely collapse? Are we going to see the data completely collapse? The GDP numbers, the ISM manufacturing, the growth numbers out there. Are we going to see a complete collapse of the growth numbers? which suggests what? Which suggests that, we may, which suggests a recession basically, right? Which suggests recession, which also may suggest that new repricing needs to be done in the equity markets. I believe that, yes, I do agree that, yes, the market is pricing in, have fully priced in that, yes, a recession is coming, but has not really priced in a real severe recession. It's priced in a soft landing recession, but not a real severe recession. I think it is likely we're going to see some sort of severe recession rather than the soft landing, and that mispricing is probably going to cause another 20 to 30% drop in the equity markets sometime in 2023. I don't know when. Maybe the first half, maybe the second half, maybe after June, right? June, July. After then, we might see that 20, 30% drop in the equity markets, and that's when you're probably going to also see the Federal Reserve start to cut rates. Let's see if it happens. But that's another key theme, is the growth data. Need to monitor the data, need to monitor inflation, need to monitor the interest rates where we're going. If we're raising rates aggressively, right, the Federal Reserve raising rates aggressively, then yes, it is going to cause the data to be worse off. People are going to feel the pinch. Consumer spending is going to feel the pinch. Consumers are going to feel the pinch. Business is going to feel the pinch. There's going to be layoffs. Unemployment rate's going to move up. Growth is going to deteriorate. The stock market is going to sell off if all of that happens, right? Now, the argument against that is, if you get a soft landing, if growth doesn't deteriorate that much, jobs are still strong, the economy's handling the amount of power that the Fed is putting on the brakes, the amount that the Fed is pushing on the brakes in terms of the interest rates, and slowing the economy, tightening the economy, increasing the rates. If the economy can handle that and it's not as bad as expected, then sure, you can get the markets to have a soft landing. You can get the equity markets to see that soft landing. And maybe it may be where they do raise rates, pause, cut, realize they made an error, inflation picks back up again, raise rates aggressively like it happened in 1980s, and then all of a sudden basically cut rates. After hiking rates, then cut rates. So it would just be like the 1980 scenario, where they raise rates, cut rates, raise rates again to try to bring inflation lower. Will we see the same thing this year? Well, we did hear Jerome Powell say that they want to avoid that, and they want to tackle inflation now. They want to raise rates now. They want to be aggressive with rates now. They want to be aggressive with rates now, and they want to tackle it now rather than and avoid that 1980 scenario. So it's more likely to see a scenario, I think, right? I could be wrong, but I think I'm more likely to see that they raise rates, they continue to keep rates elevated for some time. If they're not hiking, if they completely stop, they'll probably keep it up there until maybe something breaks, until really the demand comes down. Because remember, a lot of this inflation is supply driven, and this inflation basically can the Fed cannot do much on the supply side. They can control the demand. So how do you control the demand? You basically crush the economy with the tightening that you're doing. You crush the demand with the tightening that you're doing. You create pain for elevated time and levels. You raise rates, you sell off the bonds, you create a lot of tightening for the markets, which will cause the sell-off in the equity market, and you'll start to see the data deteriorate. So overall, projections for 2023 were, I think, the stock market, what the stock market could look like. We could probably see some more volatility. We could probably see more swings, massive, ugly bull market rallies like we've seen. We're still in a bear market, but bull market rallies followed by that when really something starts to break. And if something really starts to break, then you will see a trickle effect of panic selling, of basically low liquidity, high volatility, and very thin volume, which causes this really massive drop like we've seen in 2008, like we've seen in 2020, in 2000, right? Where you see just markets completely crash, right? The 20-30% drop. And then when that happens, right, again, the Fed will probably most likely step in. Banks and a lot of key players will come to the Fed and say, hey, what are you doing? You need to soften conditions now. We're feeling the pinch or feeling the pain. Please cut rates. And then eventually I think that will basically cause the Fed to cut rates. Now, when they start cutting rates, will we see the equity markets bounce up? Sure, that, we could see that. But it is a possibility, and if you do look at 2008 and 2001, when they started to cut rates, the market still sold off. And sold off on fear, on panic, and that might play in this year also, especially if they don't cut rates as aggressively or as fast. And especially how they pumped a lot of money in 2020 where they did QE. If QE doesn't come in as fast or as expected like they did in 2020, then you could probably see the sell-off continue, or you'll see a lot of consolidation, volatility, swings back up and down. But basically it'll be very tough for the equity markets to reverse until signs of real stimulus and pumping and QE is starting to take place in the minds of the investors and the economy and the consumers. So that's my thoughts on the equity markets. Now, for the bond market, the bond market is totally different. I believe the bond market will be different in comparison with the stock market. We've seen both correlation of bonds and stocks in 2022 where both of them sold off. I think we could see 2023 where the bond market basically ends up being the winner in 2023 versus 2022, right? Now, I don't really get into specifics of what exactly, which bond, what bond product. I talk about that more in the private chat room that I have in my on Discord. If you're interested in joining that, you can sign up on inforvesting.com or send us an email. But basically, 2023, especially if rates start to pause, and especially if we start to see a reversal where we start to see rate cuts, and you start to see really the stock market sell off, the equity market start to deteriorate, the bond market will probably be the best performing asset, in my opinion. And again, this is not financial advice, so please don't take this as financial advice. This is just my views on 2023 and what I plan to do for myself. I'm not telling you what you should do. But I think 2023, the bond market should start to pick up and should start to perform well because of this correlation that we saw last year in 2022 will start to basically shift. There will start to be an inverse correlation where you'll probably see stocks sell off and bonds move up, right? So they won't be correlated together where both stocks and bonds were both selling off like we saw in 2022. I think that shift is going to come in 2023 where the bond market will start to pick up and start to do better than the equity market. So that's my take. For the currency market, the Forex market. Now this one's tricky. I'm not doing anything in terms of currencies, so I'll put that out there. But where could the US dollar head towards in 2023? Well, I think we could see a continuation, maybe a rise in the US dollar on fear, on panic, on recession, on crashes, and also rise if the Fed continues to raise rates more than what the market is expecting. And now this is going to be tricky because if you're trading other currency pairs, like for example, Euro's also hawkish, but Europe can't, the ECB can't be as hawkish as the Fed. That's my take. So yes, they're hawkish, but it would be pretty difficult to trade that pair in my opinion. So I'm not doing anything with currencies. However, after the rate hikes are done and we do get the crash and the crash is over, I do believe that a lot of the US dollar rally that we've seen in 2022, I think that's going to completely reverse. And so then afterwards, the second part of the US dollar will probably see some selling in the dollar, and which might push all the other currencies like the euro higher, and probably the euro would be better pair. Euro against the USD would probably be a better pair because you could probably see a lot of selling in the US dollar that would push the euro higher as they are inversely correlated with each other. So that's my take on currencies. Again, I'm not doing much there, but little ifs and buts depending on where monetary policy is, and depending on where the growth cycle is, and depending on where we are in terms of the recession. But for the US dollar, I can see a two-part play, a move up higher and then a sell-off later. Commodities. Now, commodities like gold, I like gold, but if a recession hits, I think there might be some selling on some gold positions, which may present a good opportunity to purchase that dip, right? So I like gold, but in terms of a tactical trade right now, not much to do until there is some sort of bottom being formed in the equity markets, until there is a nice dip on certain, maybe your favorite gold stocks. I think that might be a better way to look at gold, in my humble opinion. I do like some gold stocks out there, some gold plays. There are some good ones to accumulate, which I'm doing. And then if the price dips even more, fantastic. I'll accumulate more gold for the next ride up. Oil, right? Oil. Now, oil is a tricky one as well, because we're seeing with the futures markets a contango. We're seeing the current contracts, the prices are lower versus the long dated contracts. The long dated contracts, you'll see the prices are much higher. So it's basically suggesting that there's going to be more supply now than there is later, and also suggesting that there's going to be less demand now than there is later. And that basically tells me it's pricing in some sort of recession, right? Now, here's the thing that can throw all of this analysis, a big wrench in all of this analysis, is the geopolitical risks, right? What Russia's doing, what, the reopening of China. They're saying the reopening of China is going to bring in demand, oil prices are going to move up. Russia is basically going to stop selling oil to the West completely, going to push oil prices up, natural gas prices higher, especially heading into next year. Next winter, if Europe doesn't have enough supply, that could be a problem. The market's going to be tight. Supply chain is going to be tight. There's a lot of issues when you have a lot of politics between the West and the East, US versus China, right? A lot of companies and corporations, US corporations, moving out from China, looking for other places to park their money, to conduct businesses in other countries, open up manufacturing plants, right? We heard about TSM, Taiwan Semiconductor, opening up an investing plant in Arizona in the US. You have some US companies moving their headquarters to India or Vietnam or other places as well. So it's this mess is going to be prolonged, is going to be there for some time. That's what I would have to say about all this. The supply chain mess. It's not something that I don't think the Fed or anyone can solve right away. And even if they do, it will be temporary. I think that this is something that is kind of a 10-year thing that needs to be figured out over time, which is going to cause disruptions, which is going to create those supply chain disruptions, which is also, I think, even if inflation comes down, it'll probably pick back up again because you still have supply chain issues. Unless there's a miracle, unless all of this war, all of this fight, there's a ceasefire, right? All of a sudden, Russia leaves, doesn't fight with Ukraine anymore, everyone's friends, businesses continue between China and US, and the ports open, and there's no supply chain issues and no animosity between the countries, West versus East, then sure, all of this can unwind and we're back to normal where we were previously, pre-COVID. But I don't think heading into 2023 and onwards, we're going to see what we saw last decade or two, which was this globalization, which was this cheap products, cheap goods. I think we are shifting, and the shift is figuring out, okay, who do we rely on now? We want to make these products in-house in our own country, but still it can be expensive. We still need to outsource certain these goods, which countries to outsource if we're having a problem with China, right? So there are some other countries out there, and creating that relationship, creating the new supply chain infrastructure, whatever they need to do in order to fix this issue, I think it's going to take its time. And that is just another caveat that could put a big wrench in this inflation problem for 2023. That supply chain. The other problem, the other wrench is the geopolitical tensions. Russia versus Ukraine, Russia versus the West, right? China reopening, basically coming back and going back to normal. What does that do with oil prices? OPEC plus, cutting production. Now, it's very funny. We've heard that China's reopening. We heard that OPEC plus, basically cutting production. We heard that Russia is going to stop giving oil to the West, yet oil prices have not skyrocketed again, back to at least triple digits, right? We didn't go above $100 per barrel. We're still around $80 per barrel, and it continues to be depressed in terms of the prices, right? So that's very interesting to note. And why is that? One could be the recession. The markets are pricing in recession coming very soon. That's number one. Number two is the US in terms of the production. Yes, they did the SPRs, the Special Petroleum Reserves. Biden basically released a bunch of oil, flooded the markets with a lot of supply of oil, and that's putting downward pressure on the prices. Can we still continue to see that in 2023? More supply from the US side that continues to push down the oil prices? Let's see, right? You do have all this geopolitical risk, and then you have the US doing something else here. Makes it very tough to figure out where oil is going to go. It's a tricky one. But as history would suggest, that if we do get a recession and we do get a demand crunch, sure, oil will basically plunge. Now, again, I talk more about oil in the private Discord chat room, my views on it, on specific tickers and certain technical formations. I talk about it there, but just for today's video, oil can be a tricky one. There are some plus points of why we could see oil move up, and some other points according to what history suggests that we could see it sell off. And if people play that playbook, that same playbook, that as history suggests that when a recession comes, oil should sell off, then if that continues to be the theme heading into this recession, then sure, you could see oil prices plunge. Now, last but not least, I covered stocks, I covered bonds, I covered commodities. Last but not least is the favorite market that everyone likes to talk about is crypto. Where's crypto headed towards? Crypto 2022, what a wild ride for Bitcoin, what a wild ride for a lot of cryptocurrencies. FTX basically imploding, Sam going to jail and then coming out, getting bailed out, a lot of exchanges going bust, Binance under the radar as well. Definitely there's a risk for 2023 that if Binance implodes, the crypto market will panic sell. Definitely. Has nothing to do with Bitcoin. All right? Binance explodes doesn't mean Bitcoin is end. Yeah, there's an end to Bitcoin. Bitcoin has ended. That's not true. I wouldn't agree with that. However, it will cause panic. It will cause massive sell-offs, which you could see in the crypto market, and will cause Bitcoin to really, really sell off if that happens. And Binance is huge. Now, let's say that doesn't happen. Can we still see crypto sell off? I think so. And I think with the recession, with the equity market sell off, with the risk off sentiment, with low liquidity, high volatility, I think that the crypto market, especially Bitcoin, can continue to sell off and stay under pressure and start to and follow in tandem with the NASDAQ index, with the tech index. So if we see sell-offs in the equity markets, I think crypto will come down with it. So that's my view. Simple kind of playbook for crypto is that I think this year is going to be another winter season for crypto, more selling pressure. And then once this sell-off, this recession and this equity market sell-off bottoms, when really the bottom comes in, then sure, you could say that, okay, the winter market, the bear market in crypto, the bear market in equities have finally ended. So those are my views. Again, this is not financial advice. Please don't take this as financial advice. These are my global economic macro views on the markets where I think things can shift. And I could be totally wrong. I totally agree. I could be totally wrong. This is 100% subject to change depending on different information and depending on what we get in terms of inflation, rates, new information we get in markets, geopolitical tension, news. So this is why whenever you hear videos like this, whether you're watching mine or anyone else, don't take this as advice. Take this as a learning experience, a learning point, a learning knowledge point for you, that how one analyzes the markets and how maybe another video or another person may analyze the markets. So this is how I view the markets. This is how I'm viewing equities, bonds, commodities, currencies, crypto. This is the correlations I see between the markets. And please do not take this as financial advice. Now, is there opportunities to come down the road? For sure. Do I see 2023 being the rude awakening of the market selling off and really the market waking up that, hey, this recession is worse than expected? Sure, I can see that, but definitely I am not a guru. I cannot predict anything down the road, so I could totally be wrong as well. So let's see. It's going to be very interesting. So I'll come back maybe to this video at the end of the year, see if I'm right, see if I'm wrong, and let me know what you guys think. Leave a comment below. Let me know what your thoughts on all these markets, stocks, bonds, commodities, currencies, forex. Any interesting stocks that you see, any interesting products that you see that have a correlation with any of these topics that I talked about, or something different that I may have missed. All right, leave a comment below. Let me know what you guys think. And again, I wish you all a very happy 2023. Wishing you all the success, all the greatness, and I'll see you guys in the next video. Cheers.